first up, despite stellar performance from the industrial index over the last few years, the current valuations imply that performance going forward may not be as good. And in contrast, the prospects for financials look decidedly better. That's according to Sanlam Private Investments. So what will provide the catalyst for the change going forward? Alvain van der Merwe joins us from Cape Town to discuss the themes. And Alvain, I think perhaps the big question is, what is the catalyst going to be to change this, the market rally that we've seen in industrials? I mean, obviously we've seen that pullback coming to the fore, but we still got resources lagging significantly.
Yeah, it is. Good evening, Bronwyn. It is always very difficult to forecast what the catalyst will be. You know, at some point the valuation differential will just ultimately lure investors to the undervalued sector. What we have found is that there's just an enormous amount of uncertainty, and I think most of local investors recognize the fact that there's a huge valuation gap between industrials in particular and resources, and of course even financials. Yet there's so much uncertainty that people don't want to make the call, because the macro context is still a context that will favor the businesses of many of the industrials that makes out our index. But what we have found, to get away from the noise, we just said we know that there's a very good relationship between the valuation, in other words the price earnings multiple of shares, and ultimately the future performance that those shares generate. And we've run the numbers going back to 1960 just to establish that particular relationship. And what you find is that not only do industrials trade on very high price earnings multiples at the moment, but they also trade on those high multiples even if you use what we call normalized or trend earnings. So you have the double whammy. It's high price earnings multiples, unnormalized earnings, and that is normally not a good recipe for future profits or future returns from that particular sector. So what will make a change? It is very tough. I think you might get better news out of the world, better news on commodities, and then people might recognize the value that sit in resources companies, and indeed also in some of the financial companies that we look at.
Obviously, Alvain, the way I understood it, we've just brought up the graph there with the industrial earnings, which has kind of justified that valuation. But I was just intrigued to get your insights into why the industrial companies have been able to grow those earnings so well. It seems to be the side of the story that investors haven't talked about much. Do you expect the same sort of earnings growth going forward, though? I mean, we know the valuations are high at the moment, but if the earnings continue to meet that, surely it would be justified.
Yes, well, firstly, if you look at the industrials, you know, if you go back 10 years, they had the initial tailwinds of a very strong local economy. And then if you look at the last few years, many of those industrials that are constituents of the industrial index are very defensive shares. So you talk about shares like SA Breweries, British American Tobacco, Richemont, which is perhaps a less defensive share, and Naspers less defensive, but they operated in very specific industries that, despite the fact that global growth was under pressure, those companies continue to grow their earnings at a rapid rate. Now, what we normally know, what happens over time, is that when your profit margins are unduly high, it will attract competition, and those margins will come under pressure at some point in time. So margins are normally mean reverting. Now, in the case of many of these companies, in Buffett terminology, some of these companies have got natural moats. The moats might be the brands or the particular product that they sell. But nevertheless, I think that the very strong earnings growth that we've seen, to my mind, is not sustainable. And it's very difficult to say why the earnings growth might come down, but we just know in history that normally happens. And although we don't say it's going to happen overnight when it goes back to trend, but over time it will certainly drift back to trend. And you know, when you build portfolios, we like to think we build it for the longer term, and we know that that is a major risk for the industrial sector.
Let's bring the South African consumer into this discussion, and how you're feeling about the health of the consumer in this country.
Probably it's an interesting question. I think it's a question that you've asked us previously as well. I think at the end of last year, we had a very tough time to explain why we didn't have any of the consumer shares in the portfolio. And I think you would agree with me, if you look at it now, it's probably easier to understand it. So maybe I should just answer the question in terms of the shares in the sector, and then try and share my view on the consumer, which might be wrong. But again, if you look at the consumer shares at the end of last year, it was a double whammy. Again, they grew their earnings at a very rapid pace. Some of the retail shares grew their earnings at 20% plus, and they traded on multiples, PE multiples of 25 times and more. So you just know that there's absolutely no margin of safety. So if the earnings growth disappoint for whatever reason, the shares are simply just too expensive. And if you look at the performance of absolutely quality companies like Shoprite, like Truworths, like Woolies, Mr. Price to a lesser extent, Massmart, all of those shares came under significant pressure, not because they came with bad results, but simply because they came with the results below expectations. And I think the market was simply too optimistic. And it's normally the case. It's a human fault that people make, is when the going is good, they become too optimistic, and it spills over in their forecasts. And that was simply the risk that we highlight. And those shares underperformed significantly, certainly in the last 3 months. If you talk about the position of the consumer, again, I think the consumer held out better than what we expected, but you can clearly see the consumer is under pressure now. You don't get serious increases in job opportunities in the country, although unions in the mining industry put a lot of pressure on management teams to increase wages. I think it will be very tough to get some of those wage demands through, because the profitability of many of these companies are under pressure, and they're just not in a position to pay that. Add to that non-discretionary goods like food, is still, the inflation rate is still 7% plus in some of those categories. Then you can understand that the consumer with arguably high debt levels is not in a particularly great position, and I can't see the position really improving certainly in the medium term.
I'd have to agree with you, Alvain, there on that note, but I'd certainly say that what's been interesting looking at some of the slides you gave us is that the position for financials looks quite positive. Just take us through your current thoughts around both the valuations of financials, which are obviously the banks and insurers, and what the opportunities are for earnings growth going forward.
Yes, I think that is a very interesting question, and to some extent it relates to Bronwyn's question, Warren. What you find within the financial sector, well, firstly, the performance wasn't great, but it was particularly the banks that didn't perform well. Because within the banks, you had the whole debacle or debate about the so-called bubble and unsecured lending, and you had shares like African Bank and even Capitec that came under significant pressure. I think as a result of the sentiment, the big four banks also didn't perform. If you look at the valuation of those banks, we normally, when we look at the valuation of the banks, we look at the price to books versus the return on equity. And they are probably fairly valued, but they're certainly not overpriced. The position of the consumer, of course, as I've described it, is not great, and therefore the major risk or concern of the investor public is that the bad debt position of some of the banks might deteriorate further. And given the high debt levels of consumers, they don't have the capacity to take on extra credit. So I think that weighed on the banks. But again, if you take a longer term view, the cycle will turn at some point, and if you can buy these things at least relatively cheaper valuations than some of the other two sectors as a basket, then I think you should do okay. Within financials, of course, what we have seen is that the assurance sector did particularly well. So if you look at some of the best performance in our market over the last 12 months, names like Old Mutual will come up, Sanlam, even MMI, RMI, all those counters did very well, and they are now, many of them are now trading at premiums to their embedded value. But I think particularly the companies with an older book has got the ability to generate cash from that life book, and the shareholders, ultimately that will be paid out in dividends to shareholders. So although even the assurers had a good run, I think if you want a low risk bet that will yield a decent return over the medium to longer term, I still think you can look at some of those counters. And the market is very volatile, and quite often the market gives you opportunity, despite the fact that these shares have run, to buy these shares 10% or 50% cheaper from their previous highs.
Alvain, you just indicated there that some of the shares of the insurers or the assurers are trading at values above their embedded value. Just take us through that for the layman. What does that actually mean?
Look, ultimately, you try to put a value on those companies, and you look at the underlying assets within the assurance company, and you also look at the value of the current business in their book. So obviously, if you've sold a policy in the past, that particular policy must have a value. So you add all of that together, and you get to a particular value. So you actually exclude the potential value of new business or new policies that they will sell in future. So what you do is then you compare the market price of the particular insurer with that underlying, let's call it kind of asset value for the insurer. And about 5 years ago, the market was very negative on the outlook for insurers, and they paid a discount. In other words, the market price traded below the actual embedded value. What has happened is that people changed their view on the growth prospects of the particular industry, and as a result of that, the sentiment changed for the better, and people are now prepared to pay a premium. In other words, the market price is slightly more than the embedded value. But if the future business can be profitable, the shareholders will still be rewarded for their holding in those insurance companies. And of course, the last thing that you've got to take into consideration is the actuarial assumptions that some of these assurance companies make. If they are very conservative, you're likely to make more out of your existing book. And in the case of Sanlam, that is certainly the case. And I think it was one of the factors that drove the share price.
Alvain, we're almost out of time, but where is the money to be made in resources?
Well, firstly, you need to be brave. And secondly, I think you need to be patient. And I think that is probably the most important part. We have decided to play resources in the diversifieds, in other words, Anglos and Billiton, and Anglos is a cheaper one. But operationally, Billiton was the far better performer, and it got rewarded by a share price. I think for the brave people, and who can take a slightly longer term view, I think the platinum producers might well be the positive surprise over the next 10 years.